Chapter 8, Owner's Equity. So we've gotten through the entire balance sheet so far, with the exception of the equity section. The equity section has the potential to be very complex, or not complex at all, depending upon the type of business organization we've got. Of course, we've got our fundamental accounting equation, assets equals liabilities plus owner's equity. And the question comes down to, how do we need to structure this equity section so that it provides the proper amount of information? If we've got a sole proprietorship, which is the most common form of business organization in the United States, we don't need a lot of complexity. We have a single owner, and everything that the company owns that doesn't have to be paid out to creditors belongs to that one owner. So the sole proprietorship will have a single account called capital that tracks the ownership stake. The next level up of complexity is the partnership, since it adds multiple owners. From a balance sheet standpoint, however, all we need to do is add a second capital account, or a third, or a fourth. Each account will track the specific ownership stake of that individual partner. And if we've got perhaps a large accounting firm, we might have 1,000 capital accounts, or more, one for each partner. The most complex equity section is going to belong to the corporation, and that's what we'll be spending the remainder of the class looking at. The corporation may have several classes of stock, as well as that additional capital account that we talked about back in Chapter 2. And of course, there's retained earnings. We could have options outstanding. We might have repurchased shares of our own stock. That's treasury stock. So there's quite a bit to think about. So that's what we're going to be doing in this class. Regardless of how it's structured, ultimately what we're talking about is the residual interest of the firm. What's left of the assets after the bills have all been paid. Before we get into that, let's back up a few moments and talk about what would make us want to incorporate in the first place. Being a corporation has some positives and some negatives. The first, and probably most important benefit, is limited liability. And what this means is that there's a firewall between the firm and its owners. If the company goes bankrupt, the creditors can liquidate the firm, but not reach out and seize any of the assets of the stockholders. This includes not only the company being run poorly, but also if there's litigation against the firm. Do you remember how we said consolidated financial statements included all these little subsidiaries owned by the parent? Here's why we'd have all those subsidiaries. We can invest in a risky new product or line of business, and if things go south, the only assets on the hook are the ones we invested. An example of this would be Dow Corning. These were the folks who made the silicone breast implants back in the 80s, and there were a number of class action suits against them claiming the implants caused everything from cancer to lupus to neurological disease. Liability forced Dow Corning into bankruptcy protection, but the two parent companies, Dow and Corning, as well as all their other subsidiaries, were protected from liability. If we were a sole proprietorship or a partnership, on the other hand, our creditors have the ability to make us sell our home, mortgage our spouses, and sell our children for medical experimentation. Well, maybe not those last two, but it's not a pleasant prospect. In 1990, the seventh largest accounting firm, Laventhal and Horwath, or something like that, liquidated, due in part to litigation claims, and the partners were required to pay in several $million of personal assets to pay off the liabilities. Partnerships have joint and several liability, which means everyone is liable for everyone else's actions, and each individual can be held wholly responsible. So the corporation has a big plus in the column for this. The second bonus we get to the corporation is that it's easier to attract equity. Clearly, if we're a sole proprietorship, the only place equity capital is coming from is us. But think about the partnership thing. If we want to get someone to pitch in to the pot, they become my partner, and now I'm on the hook for everything they do. That means I'm going to have to really trust them, and that means there aren't a whole lot of people that I'm going to be able to tap like that. But with a corporation, I can issue shares to anyone and their uncle. Who specifically owns the shares doesn't matter to me, so long as they pony up the money and allow me to grow. The last biggie worth talking about is ease of transferability. When you buy shares of stock in a company, those shares generally come with no restrictions regarding when and to whom you can sell them. As soon as I want out, if I can find a buyer, I can get out, no problem. This takes a huge weight off my chest because now I don't have to be worried about being saddled with something I can't unload. With a partnership, on the other hand, we can't make a transferal like that. We can sell our stake in the partnership earnings, but we can't actually sell our ownership, nor can we sell our partnership rights, unless we have unanimous approval of all the other partners. By law, you can't be a partner against your will, so if my partners don't like the guy I want to sell to, the deal is off. We've got a list of items on the negative side as well. First and foremost, corporations are subject to double taxation. What this means is the corporation gets taxed based on its net income, and then when it pays a dividend to shareholders, they get taxed at their individual rates. So the same income is being taxed at two layers. Corporations are more costly to organize and maintain than partnerships and sole proprietorships. Corporations require filings with the Secretary of State of whatever state in which they're incorporated, and the corporation needs to maintain certain procedures, such as board of director meetings and the like, in order to continue to be considered a corporation. A partnership, however, can be formed with a handshake and nothing more. It would be foolish to not get the lawyers involved, but it's by no means necessary. Lastly, the corporation has only one way of distributing profits to owners: dividends. And dividends are paid on a per-share basis, so if we want to distribute more profits to any one owner, they need to own more shares. And owning more shares gives them more voting power, which is not always what we want to do. Partnerships, on the other hand, can develop any crazy way they want to distribute the firm profits to owners, so long as everyone agrees to it. So let's talk about common stock, which represents an individual owner's stake in the business. When the business is incorporated, the corporate charter will state the total number of shares that the firm is authorized to issue. This is typically a ridiculously large number compared to what they plan on issuing at their initial public offering, to give them the flexibility to issue more shares in the future. Should they need to issue more shares than the authorized number, the shareholders will have to vote to change the corporate charter. The most important thing to realize about stock is that within each class, each share is identical. If you buy one share of stock in a business, you're buying one ownership stake in that business, and that ownership stake is the same as everyone else's. Each share of stock comes with a number of rights, and if you were to buy 2 shares, you would have twice the rights than if you had bought 1. Importantly, if you want more of those rights than someone else, the only way to do it is to own more shares. So what do we get with each share of common stock? Well, first of all, we get proportionate share of profits and losses. Each share gets 1/nth of the profits or losses generated by the firm, where n is the total number of shares outstanding. Recall that owner's equity is the residual interest. Whatever we make beyond what it costs us to make it goes here, and this is how it gets apportioned. It doesn't mean that it'll be distributed as dividends right away, but that money is yours, tucked away in the business. We also get proportionate management rights. Now, our management rights aren't the same as what come with a partnership. With a partnership, all the partners have the ability to sign contracts on behalf of the business. With common stock, there is no direct control of day-to-day operations. What we do get to do is vote. If you own shares of stock, you will have seen proxy statements come in the mail along with the voting certificate. If you've never seen a proxy statement, the 2010 one for Coca-Cola is in the course folder for you to download and look at. We get to vote on who the auditor will be. We get to vote on various proposals initiated by other shareholders. Most importantly, we get to vote for the board of directors. And then it's the board of directors' job to hire and fire management and to make sure that the business is running the way it ought to. And if we are dissatisfied with the direction the business is going, and the board of directors won't fire management and hire new folks, then we vote them out of office and put in people who will fire management and replace them with new folks. 2 related points. First, when you look at the proxy statement, take a look at the shareholder proposals, starting on page 100, because they're pretty cool. Any shareholder can propose one of these things if they want. They then write up an explanation as to why they think it's a good idea. The board of directors will express their own opinion on the matter, and then the shareholders vote up or down. As you can see, the board of directors doesn't take too kindly to shareholder proposals. The second relates to the boards. If you're sitting on one, or should find yourself sitting on one in the future, it's important that you educate yourself about your responsibilities. In the past, many treated them as rubber stamp sorts of things, nodding their head to whatever the CEO asked for. Those days are gone, and the fiduciary responsibility of a board member is something to be taken very seriously. Next up, proportionate liquidation interest. One of these days, maybe in the distant future, the firm is going to liquidate, and when it does, and all the liabilities are paid off, the shareholders will split the rest. They'll chop that amount into n chunks, and each share will get one of those chunks, just like we got 1/nth of the residual back up in the proportionate profits and losses. The last right that the shareholders get is the preemptive right, and what this does is allow the shareholders to maintain their proportionate interest in the firm anytime new shares get issued. If you think about this, it's our protection from being screwed. Let's say that you are a 20% owner in my company, and you are rabble-rousing. Kind of like the Hamburglar, but less robble-robble and more rabble-rabble. I might be inclined to sell a bunch of shares to someone else for a penny a share. That would dilute your ownership, and it would make it harder for you to cause mischief for me. What the preemptive right says is that if I want to offer 1,000,000 shares at a penny each, you have the right to buy 200,000 of them, your 20%, also at a penny a share, so that you can keep your 20% ownership stake. Essentially, it's the right of first refusal. So that's what we get when we buy a share of stock. Looking at the corporate balance sheet, let's talk about what we're going to see there. First, we've got our capital stock, which is a broad term that encompasses all our stock issuances. This includes both common shares and preferred shares, and there can be multiple classes of each. We'll talk a bit more about preferred stock in a couple minutes. All of these stock accounts, when they are initially issued, will be credited for shares times par value, such that if we take the balance sheet value and divide it by par, that will tell us how many shares we have issued. So what is par value? Well, today it's mostly a nonsense number. Back in the days of unregulated securities markets, par value was an established minimum amount that the stock could be sold for, guaranteeing that buyers at the initial offering wouldn't be undercut by someone else in the future. Par value today is an arbitrarily low amount of money that gets assigned a company's stock as an artifact of old state securities laws. I've seen dollar par, I've seen 10 cents par, I've seen penny par. And a promise not to sell shares for less than a penny is clearly not a promise that I need. So we've received some cash from the issuance of our stock, and we debit cash. We credit common stock for shares times par, and then we're faced with a journal entry that doesn't balance. Clearly, if par value is a penny a share, the cash that we receive per share will be much more than par. So we've created this second account called APIC, or Capital in Excess of Par, or some similar name. This account acts as nothing more than a plug between the cash we received and the stock's par value. So, we're able to get our journal entry to balance by plugging the difference here. Each class of common stock or preferred stock may be given their own APIC accounts, but ultimately we need to recognize that the distinction between cash and APIC is completely arbitrary. That's it. The last thing is our retained earnings. This is the sum total of all the profits generated by the firm that have been retained within the firm. That is, they haven't been paid out as dividends. Where are they? They've been reinvested in the business, buying more inventory or expanding productive capacity, something along those lines. If you remember Chapter 2, Koch calls this account reinvested earnings instead of retained earnings, and that's a pretty cool name for it. There are a couple of items that we should be aware of regarding these accounts. First, once shares of stock have been issued, the company generally doesn't care about them anymore. That is, stock is transferable, so if I issue shares to you, and you sell them to your brother, who sells them to his coworker, who sells them to her mailman, none of that matters to me, the firm. That's not to say I don't want to keep the shareholders happy, and I do need to know to whom I pay dividends and send proxy statements from time to time. But from an accounting perspective, the trading of our shares in the secondary market has nothing to do with us. The second thing is about retained earnings. Note that retained earnings is not cash. It's not revenue. It's not anything other than the slush account into which all our temporary accounts are closed. One of the purposes of the Ronco project was for you to follow the accounting flow and see exactly what ended up in retained earnings when you were all done. Just because we have retained earnings doesn't mean we're rich, and it doesn't mean that we can afford to pay dividends. We need cash to pay dividends, not just retained earnings. Okay, so let's book some journal entries to solidify what we just learned. We'll start simple. Dave Corp issues 500 shares of $5 par common stock for $10 per share, incurring $200 of investment banking fees associated with the issuance. So here's how it works. We find an investment banker to find buyers for our offering, and then they get paid a commission for the work that they did. That's that $200. So what did we do? Well, we know that we just received cash, so we'll debit cash. For how much? Well, not all $5,000, since we had to pay that investment banker, so we'll debit cash for $4,800. We issued common stock, so we have to credit our common stock. For how much? For shares times par. 500 at 5 is 2,500. Our journal entry doesn't balance, so we're going to end up plugging here to our APIC account the remaining 2,300. The $4,800 of investment is split on the balance sheet into these two accounts. Now, some states don't have par value. Corporations are governed by state laws, and some states don't require us to set a par value. If this is the case, then we skip the APIC part and simply plug all the money into our common stock account. These notes were written while I was on vacation at Disney World, and it appears that this was MGM Day. Kermit Corp issues 700 shares of no par common stock for $20 each. What did we receive? $14,000 in cash, so we debit cash, and we put all $14,000 into the common stock account. Functionally the same as the Dave Corp example above, but with only a single equity account instead of two. Some states have said that the par value thing is a crock, so you don't have to put a par value on the stock. But gosh, we really need a number on that certificate, just because. So these shares will have a stated value, which for our purposes is the exact same thing as par value. When Fozzie Corp issues its shares for $800, we put the $800 into cash, we record the common stock at shares times par for $200, and we plug the rest to APIC. We aren't always going to be issuing shares in return for cash. When a company is first being set up, it's possible that one of the founders will contribute other assets to the business that it needs to get off the ground, just like with Ronco. Land, equipment, inventory, and whatnot. As we discussed back in Chapter 6, we record this transaction at its fair value, however we can obtain that information. If we're a private firm, it may be difficult for us to get an accurate value for our stock without paying an appraiser. In this case, we would attempt to determine the value of the assets received, and then we would book the transaction just as when we receive cash. Here we've got a piece of land with a value attached, so we'll debit the land for $5,000. We'll credit common stock for shares times par, or $1,200, and we'll plug the difference to APIC. If, on the other hand, we've got a reliable price for our shares of stock, that's the one we'll use. We just issued 400 shares of stock worth $7 each, so the land must be worth $2,800. We put the $1,200 into common stock, $1,600 into APIC, and we record the value of the land as the value of the stock. As it happens, we don't even have to receive an asset in return for our shares. Let's say the toilet overflows because someone leaves something there. Yeah, that's something. If the plumber comes and roto-rooters our pipes and is willing to accept shares of stock instead of cash, we would record the transaction exactly the same way, replacing land with plumbing expense. And that's about what a plumber makes for a couple hours of work. Oof. Word of advice, if this business school thing doesn't work out for you, become a plumber. This is more likely to be some sort of legal or accounting work, but plumber is much more fun. We have another type of stock, preferred stock. And what is the point of preferred stock? Well, it bridges the gap between common stock and debt. If we wanted to think about risk and return, who bears the greater risk, the stockholder or the debt holder? Clearly, the stockholder does. The debt holder gets their money back first, and only if there's anything left does the stockholder get anything. But what about return? Who has the highest earning potential? Again, it's the common stockholder. The debt holder gets their interest payments at 6% or 8%, and they get their money back at the end of the term, but the common stockholder's return is theoretically infinite. All of the profits the firm generates go to the common stockholder, so the sky really is the limit. If you had loaned money to Microsoft back in the 1980s, you'd have gotten your interest and that would be it. And you would be kind of sad. If you had bought stock in Microsoft back in the 80s, you wouldn't be worrying about getting your MBA right now. And you would look like this. So what preferred stock does is it bridges these two. It's a little less risky than equity and a little more risky than debt, and pays a dividend that provides a higher return than debt, but doesn't have the same upside potential of common stock. So it lets the investor take a little more risk and get a little more return than straight debt, without making them commit all the way to buying common shares. Now, how does it work? Well, it's called preferred stock, not because people prefer it to common stock, but because it receives some preferences over common stock. In return for these preferences, preferred stock typically gives up the right to vote, or at least votes with less weight than common shares do. What are the preferences typically associated with preferred stock? Preferred dividend payments, certainly. In any year in which the firm wants to pay a dividend to common shareholders, preferred shareholders get their full dividend before even a penny goes to the common shareholders. Note that dividends aren't mandatory, but if we do choose to pay them, the preferred shareholder gets paid first. The second preference is at liquidation. After the debt holders have been paid, the preferred shareholders get all of their money back next, and only then do common shareholders get to split up what's left. Why does the investor want to get involved in this preferred stock thing? Well, we take less risk than common shareholders, but we get a higher return than debt. And preferred stock typically trades on exchanges just like common stock, so it's pretty transferable. On the company side, preferred stock is also appealing. Unlike debt, preferred stock never has to be paid back until liquidation. We don't have to worry about millions of dollars in debt coming due in the future. It just sits there like common stock until the end of the firm. Along a similar vein, dividend payments are optional, whereas interest payments are very much mandatory. If we fail to make an interest payment, they can demand their money back immediately. If we fail to make a dividend payment, well, that'll be reflected in our stock price, but it won't be the same catastrophe that is missing an interest payment. Lastly, preferred stock can improve the perceived quality of our ratios. Think about our debt-to-equity ratio. If we issue preferred stock, then our debt-to-equity ratio will shift downward because preferred stock is an equity investment. Whereas if we issue the same amount of debt, our debt-to-equity will go up. And we already know that debt-to-equity is a measure of bankruptcy risk, so the shareholders might get spooked. Now, just like the bonds we saw in the last chapter, preferred stock has a number of options that can come with it. The first, and probably most common option, is cumulative dividend payments. As I mentioned, one of the benefits of preferred stock over debt is that dividend payments are optional. If the board of directors doesn't declare a dividend, there's no dividend paid, and that's that. So we've got this preferred stock that investors have given up their voting rights on in return for dividend preferences, but you say dividends are optional? That seems like a recipe for being screwed. So when preferred stock is cumulative, that means that if we don't make good on our dividend payment this year, it rolls forward to the next. And if we don't pay one next year, then they both roll forward to the third. In the grand spirit of Beavis and Butthead, this is called in arrears. In arrears. These dividends in arrears must be paid before the common shareholders get their dividends, and if dividends are never paid, then they must be paid before the common shareholders get anything at liquidation. So it might take a long time, but cumulative preferred shareholders will eventually get their dividend money. The next option would be participation in common dividends. This would be called participating preferred stock. These guys get, in addition to their stated dividend payment, some portion of the common dividends as well, often on a 1-to-1 ratio. We can have convertible preferred stock, just like the convertible bonds last class, in which the preferred stock is convertible into common stock at some predetermined ratio. Again, it gives the investor the relatively lower risk of preferred stock with the upside potential of common stock. And we can have callable preferred stock, which means that the firm can require the shareholders to tender their shares in return for cash at the firm's discretion. Let's issue some shares of preferred stock. We're going to do this the exact same way we issued common stock. Goofy issues 1,000 shares of $100 par, 5% preferred stock for $102 per share. We received $102,000 in cash, so we debit cash for $102. We credit preferred stock for shares times par, which is $100,000, and we plug to APIC, that'll be $2,000. How much do we need to give our preferred shareholders in dividends before we can pay our common shareholders anything? 5% tells us the dividend payout, and each share will receive a $5 dividend next year. We've got $100,000 of preferred stock outstanding, a 5% dividend rate. That means that the first $5,000 of dividends each year get paid to the preferred shareholders. Next subject, treasury stock. Now, if you recall, I said earlier that in most cases, once we issue shares of stock to the public, we don't really care what happens to them. And that's true. The shares are changing hands, perhaps thousands at a time, at all hours of the day, being bought and sold by people through their brokers. But what if we were the ones to buy our shares on the market? When that happens, we get treasury stock. Treasury stock is what we call the shares repurchased by the firm and not retired. So the shares continue to exist, they just aren't being held by the investing public. Now, it's important to understand something about treasury stock. We're going to end up debiting it when we make the purchase. We'll be debiting treasury stock and crediting cash, just like when we bought shares in Bobco way back when. This debit is not an investment in ourselves, it's a reduction in equity. When investors gave us money and we gave them stock, we called it equity. They contributed capital to the firm. When we give our investors money and they give us back the stock, we're cashing them out. We are reducing the amount of capital invested in the firm. So in summary, treasury stock is not an asset. Now, I don't say this just because treasury stock is not an asset, but also because treasury stock is not an asset. Now, you may think that treasury stock is not an asset, but treasury stock is not an asset. Why don't you go ahead and say it with me? I promise you, your spouse or your roommate or the cat won't laugh at you. Treasury stock is not an asset. So why are we doing this? Surely we have better things to do with our cash than buy back our own shares on the stock market. Well, there are a number of reasons to do so. These are just the ones that occurred to me when I was writing down these notes. I'm sure that there are more. The first has to do with tax consequences, despite the fact that I'm not a tax guy. Please don't ask me tax questions. I'll get them wrong. But share buybacks are tax advantaged compared to dividend payments. Say the firm has a bunch of cash lying around, and it can either pay dividends or buy back shares. Well, what do we know about dividend distributions? Who gets those? Everyone, right? If you have 1 share, you get 1 share's worth of dividends. If you have 10 shares, you get 10 times as much. So when we declare dividends, everyone is getting paid, and everyone is paying taxes whether they want to or not. On the other hand, say we use that cash to buy back shares at the market price. Investors who sell will still have to pay capital gains on those transactions, assuming that they are realizing a gain, but the only ones who will do so and face the tax consequences are those who choose to. Those who don't want the cash and the associated taxes can pass on the sale. They are also advantaged in that if we have capital losses from other stock transactions, those losses can offset capital gains with no maximum, whereas capital losses' ability to offset ordinary income is capped. Why else are we doing this? Well, perhaps we need those shares for something. If we have an employee stock purchase plan, or we want to use shares as part of a corporate merger deal, the shares for those things have to come from somewhere. It's easier to buy shares already out on the market and then reissue them than to issue brand new shares from scratch. Why? Well, remember that preemptive right thing? Wouldn't that be an enormous pain if we had to give all our shareholders right of first refusal every time we wanted to sell a few shares to an employee? Ugh. We can use treasury stock as a way to thwart takeover attempts, because I play Dungeons & Dragons and we say thwart a lot. And huzzah. Huzzah! So how do we thwart this takeover attempt? Well, first, let's talk about hostile takeovers. What is it that's going on here? Gordon Gekko says, "I want to buy Dave Corp." And Dave Corp's board of directors, onto his shifty deeds, decides they're not interested. So what does Gordon do? He lets the world know that he's willing to buy shares of Dave Corp for 25% above the current market value, and any shareholders interested in doing so should fill out a little form. If he's able to get 50% of the shares plus 1 committed, then he pulls the trigger and buys them. If he doesn't get that magic number, the deal is off. And then, when he has all those shares, what does he do? He calls a vote. All in favor of selling Dave Corp to me, say aye. Aye! I win, because Gordon always wins with 50% of the shares plus 1. And that's all she wrote. So that's what he's going to try to do. His ability to succeed is based entirely upon finding people holding enough shares willing to sell to him to get to 50% plus 1. But if someone is willing to sell their shares to him, they'd be willing to sell their shares to anyone, including us. So they don't care who's buying them. All they care about is getting their money. So let's say that Dave Corp has 100 shares outstanding, of which 40 shares are owned by company insiders who are uninterested in selling, and 60 are held by people who don't care one way or the other. Let's say that the company were to repurchase 21 of the shares. What do we have now? We've now got 79 shares outstanding, of which 40 are held by insiders, and only 39 are held by outsiders. What have we done? We've now made it impossible for Gordon to get that 50% trigger. Even if he bought every other share outstanding, he still couldn't win. In reality, it's a little more complex, but that's the gist of it. Lastly, and every time I teach this class, I think about whether or not I want to include it, buying up shares of our company could be seen as a good investment. I know I said that this isn't an investment in ourselves, and it isn't, but hear me out. Who knows better than anyone what is the true value of a company? It's not the shareholders, and it's not the financial analysts. It's company's management, who can see how their strategy is working and know whether the market is making the correct assumptions about future prospects of the firm. So say the stock is trading at $10 a share and management believes it should be trading at $50. Buying shares now and then reissuing them later can net the company quite a bit of cash and the non-selling shareholders quite a bit of wealth. Keep in mind, though, that the insider trading laws apply to treasury stock as well, so this isn't free rein to plunder. Arrgh. Okay, so treasury stock is not an asset. We got it, Dave. So how does this stuff show up on the balance sheet? Well, let's buy some treasury stock for $15 a share. Of course, we're going to credit cash for $1,500, and we'll debit the account treasury stock. There's that debit I warned you about. No, it's not an asset. It's a contra equity account, and it lives down in the equity section of the balance sheet as a negative number. Par value is ignored. We debit treasury stock for the full amount that we paid, and then of course we credit cash. Now let's fast forward to the point in the future where we decide to reissue those shares for $17 each. Huzzah! We're $2 a share ahead. However, this isn't an asset, and we can't recognize a gain or a loss on it. So, when we debit our cash for $1,700, we will credit treasury stock for $1,500, the amount that we actually have in the T account, and we'll plug the extra $200 into what? Into APIC. This isn't a gain. We're treating this as if those shares had actually been issued for $2 more way back when we originally issued the shares. What if, on the other hand, we issued it for less than we paid? Let's reissue for $10 per share. We're going to debit cash for $1,000. We'll credit treasury stock for $1,500, and we have to plug to a debit. What do we debit? APIC again, reducing the amount of capital contributed by shareholders. Last example. What if we don't have enough or any APIC? Well, we can't have negative APIC because the A means additional, and that's just silly. But we can have negative retained earnings. It's called accumulated deficit, and we would have seen it on Lucent's balance sheet if we'd used that one in Chapter 2 instead of Koch's. So that's where it'll go. Debit cash for $1,000, credit treasury stock for $1,500. We're going to zero out the $200 that we do have in APIC, and we'll plug the remaining debit into retained earnings. It is possible that we might want to retire the shares outright. If that's the case, we zero out the treasury stock account, remove those shares from the common stock account at shares times par, 100 shares at $1 par, and we once again plug to APIC or retained earnings as needed. So that's treasury stock. Okay, the world of dividends. Dividends are one of the ways that investors can earn a return on their investment, the other, of course, being capital appreciation. So dividends are only one aspect of the stockholder-firm relationship, and firms differ significantly in their dividend policies. Shareholders can influence dividend policies, though I think it's fair to say that investors will gravitate towards firms whose dividend policies already align with their needs. What do shareholders want from dividends? Well, certainly, there are some who are interested in the periodic cash flow. As I said back when we were doing the cash chapter, once a company institutes a dividend policy, they tend to have to stick with it. So companies with relatively high dividend yields can be good for investors on fixed incomes who count on that quarterly check to buy groceries and pay the rent and such. Corporate finance theory suggests that a second way that dividends help out shareholders is indirectly as a constraint on management. If management has a bunch of cash lying around, they'll be tempted to spend it, possibly spending it on perks, but just as likely spending it to expand their empire by purchasing other companies, or perhaps even by buying a baseball team. Cash paid out as dividends, however, can't be spent by management in other suboptimal ways. Lastly, depending on your tax status, you may or may not want a dividend. People who pay taxes may be less likely to invest in high dividend yield firms, whereas non-taxable entities, such as not-for-profits and foundations, may look to those dividends to fund scholarships or programs. On the other hand, the dividend policy has to fit the business as well. The converse of that management constraint thing is the need for cash to finance growth opportunities. Managers don't only squander shareholder money, they often make very good decisions with it. If our spare cash is all being paid out as dividends, when that nice juicy investment opportunity comes along, we may have to go borrow at 8 or 10% to pay it, which would be a shame. Take Berkshire Hathaway, for example. This is the investment company run by Warren Buffett, the Oracle of Omaha. They've never paid a dividend on the premise that they can invest your money better than you can. And you know what? They're right. Berkshire has earned a return of over 430,000% since 1964. They maintain a cash reserve of about $20 billion, so when the next good investment shows up, they'll be ready. In certain cases, we're not allowed to pay dividends. If we owe the bank a bunch of money, they're not going to take too kindly to our distributing dividends to our shareholders. Our borrowing contracts are likely to have constraints on how much we can distribute in any given period. Lastly, as I mentioned above, once we initiate a dividend payment, we need to keep that up. They are, in a way, like giving your significant other a back rub. Once you've started doing so regularly, if you ever stop, your stock price will plummet. If stock prices are based on expectations of future profits, any information that brings those future profits into doubt are going to make our stock price go down. Skipping or decreasing or canceling our dividends absolutely falls into that category, and our stock price will suffer for it. So the cash and generic dividend process. If we pay a dividend in cash, this is how we're going to do it. If we pay a dividend in stock, this is how we're going to do it. If we pay a dividend in Twinkies, year-old or otherwise, this is how we're going to do it. The dividend starts with the date of declaration, and the board of directors makes its declaration on, say, May 30th. It's not management who decides to pay a dividend. It's only the board that has the authority to do so. At that point, it becomes a liability, and we have to pay it. This was Magic Kingdom Day, and we got to have breakfast with the princesses. My son, who was 2 at the time, showed me a picture of Jasmine once, and I said, "Yeah, she's hot." And for weeks afterward, he would walk around saying, "Jasmine, hot." Anyway, Jasmine decides to declare a dividend of 30 cents per share on its million outstanding shares. We make this distinction that this is a distribution of firm profits, so we know it's going to come out of retained earnings. There is also such thing as a liquidating dividend, and those dividends will come out of APIC. That would also come from the board of directors. So the dividend has been declared. Let's book it. We debit dividends declared, which is our temporary account. That's going to get closed into retained earnings at the end of the period. And we credit dividends payable, since we now have a liability to our shareholders. So that was the date of declaration. You'll note that it said we would pay dividends to shareholders of record on June 30th. This is a function of that great transferability that stock has. On May 30th, when they declared the dividend, they had absolutely no idea to whom they should give the dividend. They need time to figure out who owns shares and who doesn't, so they specify our second date, this date of record, right here. Anyone who owes a share of Jasmine Inc. on June 30th will get the dividend, regardless of whether or not they have the shares on July 1st, or regardless of whether or not they hold the shares on May 30th. So on June 30th, everyone will report in, typically done by the custodian of their shares, E-Trade, State Street Bank and Trust, Schwab, whoever. A great big list is compiled, and now we know to whom we should write the checks. There's nothing we need to do in the accounting system, though, so we'll just put in a smiley face in 42-point font. Now, what do you think happens to the stock price of these shares on July 1st, the day after the date of record? Well, let's see if we can't figure this out. Let's make some additional assumptions about Jasmine. Let's say that the company has a total value of $10 million, and if there are 1 million shares outstanding, that gives us a per share value of $10 per share. Now, that $10 million of value includes $1 million of cash and $9 million of other stuff. So, if you were to buy a share of Jasmine, and here's our share of Jasmine, you would get $1 of cash, and you would get $9 of other assets. Now let's hold all that constant over time just for the sake of simplicity. And the first question I will ask is, well, what would you pay for a share of Jasmine on May 15th before the dividend is declared? Well, I just told you the answer. It's worth $10 a share. You're getting your $9 of other assets and your $1 of cash. Now, what would you pay for a share of Jasmine on June 1st, the day after the dividend was declared? It might be tempting to say that you'd pay $10.30, but let's see what you get. The dividend process takes $300,000 of cash out of that $10 million and sets it aside for the dividend payment. So we'll chop off this little bit right here, and we'll say that's the dividend cash. So if you're buying a share of Jasmine now, what are you getting? You're getting $9 of other assets, you're getting 70 cents of cash to be retained within the firm, and you're getting rights to a 30-cent dividend payment that'll be distributed at some point in the future. We're getting the exact same thing we were going to get yesterday on May 30th before the dividend was declared. We're just chopping it up differently. So the dividend declaration doesn't create or add value in and of itself. Now, let's fast forward a little bit. And let's go to June 30, the date of record. What do you get when you buy a share of Jasmine? Still that same stuff, right? It's not until tomorrow, on July 1st, that things change. Because now, on July 1st, if you buy a share of Jasmine, what do you get? You get the $9 of other assets, you get the 70 cents of cash being retained within the business, but you don't get that 30-cent dividend that just got erased by my program. I'll throw the 30-cent in here like this. 30 cents. That belongs to the person who held the shares on June 30th. So what would you be willing to pay? Not 10 anymore, only $9.70, because that's all that you're getting. Occasionally, a student will ask me, well, don't people rush to buy the stock on June 30th so that they can get the dividend? And the short answer is no. The longer answer is no. The even longer answer is, yeah, we could do that, but it would actually not be a very wise move. If we buy the stock on June 30th, we're paying $10, right? And then we get a 30-cent rebate. That's our dividend payment. We're out a total of $9.70. If we buy the stock on July 1st, what do we pay? $9.70 for the share, and that's that. Either way, we're going to be out a net of $9.70 out of pocket, and we'll have that share of Jasmine going forward. But if we receive the dividend of 30 cents right here, what happens? We get stuck paying taxes. So we'll actually be out a little bit more than $9.70 in return for the share of Jasmine once we take into account the taxes. Okay, date of payment happens, that's our third date, and we write the check for $300,000. We will treat this exactly like we treat any liability that we're paying off. Credit cash for the $300 and debit dividends payable for the $300, and we're done. One last stocky thing: stock dividends and stock splits. Both are ways of increasing the number of shares held by current shareholders, but the mechanism is somewhat different. With a stock dividend, we're going to go through the same 3 days that we had for the cash dividend, the only difference being that the date of payment will be issuing shares of stock instead of cutting checks. If we have what the SEC considers to be a small stock dividend, which is a dividend of less than 20 to 25%, we'll value that transaction at fair market value. In other words, we'll act as if we wrote checks to our shareholders, they cashed the checks, and then immediately repurchased shares from us at the market price. Here is Beast Enterprises with its million shares, and it wants to issue a 10% stock dividend. This is a small stock dividend, and so we're going to value this at fair market value. We've got a million shares at 10%. That means we're going to be giving out an additional 100,000 shares of stock. And since the current going rate for them is $5 per share, we're pretending to give our shareholders $500,000 of value. We will debit our dividends declared account for $500. We will credit common stock dividend distributable for shares times par, or 100, and we will plug to APIC for 400. When the date of payment comes along and we actually give the shareholders their share, we'll debit away this account right here, and we'll credit our common stock. On the other hand, we could have what's considered a large stock dividend, which is greater than that 20 to 25%. We will value this transaction at par, not at fair value. This means that there's no APIC. The dividend only affects the common stock account. Let's say that Beast had declared a 40% dividend instead. 1 million shares times 40% is 400,000 shares. At $1 par, we're going to pretend that we gave our shareholders $400,000 of dividend. We'll debit our dividends declared and once again credit common stock dividend distributable for shares times par, or $400,000. And that's that. You'll note that in both of these cases, I said we were pretending to give our shareholders value. We already saw that when we pay a cash dividend, we're not giving the shareholder anything they didn't already own. But it's even more of a charade when we pay a stock dividend, because this way they can't even cash the check and go out to dinner. But Dave, with that small dividend, didn't we give them 100,000 shares worth $5 each for a total of $500,000? What's so pretend about that? Well, what's so pretend is that the underlying value of the company hasn't changed. If Beast was worth $5 million before the dividend, it's worth $5 million after the dividend too. All that we did was split it into more, smaller chunks. That guy who used to own 10,000 shares owned 1% of the company. With a 10% stock dividend, he now owns 11,000 shares, but that's out of a total of 1.1 million shares, and so he still only owns 1% of the company. We didn't give him anything other than more pieces of paper. He still owns 1% of 5 million. So why do we have a stock dividend? Well, maybe the shareholders are clamoring for something, but we don't have any cash handy, so this is our way of throwing them a bone. Perhaps we're looking for a way to decrease our visibility. If we've got gobs of retained earnings, people might think that we've been too successful on the backs of our employees and by screwing our customers. So a stock dividend reclassifies some of that retained earnings into stock, decreasing our visibility to detractors. Probably the best reason to use a stock dividend is to give the shareholders a choice as to how they want their money. If they want the cash, they can sell the new shares. If they don't want the cash, they can continue to hold the new shares indefinitely. That would save them taxes in the short term, since stock dividends generally aren't taxable. Then we have the stock split. Rather than issuing new shares, we are essentially taking the shares we already have and are tearing them in half. So when a stock split happens, the number of shares issued is going to go up. The number of shares authorized is going to go up. Essentially, we are pretending to go back in time and issue these new micro shares rather than the regular shares we did issue. And if these are micro shares now, what's going to happen to their par value? Going to decrease it, of course. Now, an important thing to recognize is that treasury shares can't receive dividends, including stock dividends. With a stock split, however, we are fundamentally altering our shares of stock. The old jumbo stock has been completely replaced by the new micro shares, including those that were held in treasury. Here's our example. Beauty Enterprises has 4 million shares authorized, 1 million shares issued and outstanding, with a par value of $1 and a current market value of $5 per share. If Beauty has a 2-for-1 stock split, where does that leave us? Well, with 8 million shares authorized, 2 million shares issued, par value of 50 cents, and a market value of, well, you'd think it would be about $2.50, right? It would make sense that it would be a linear relationship. Since we had a company worth 5 million before the split, we would expect the company to still be worth 5 million after the split. And since we've got 2 million shares, that would be $2.50 a share. Interestingly, it's not. It might be $2.55 a share, or $2.60 a share, something more than the $2.50 that we would expect. And that brings us to the point of a stock split, which is different than the point of a stock dividend. What's the point of a stock split? Well, theoretically, there shouldn't be one. But what do we get when we have a stock split? Well, we get more shares, right? And we know that more shares should give us a lower price. And what does that lower price do? Well, now it puts our shares in the sights of a new group of investors who previously thought our stock was too pricey. They weren't willing to buy it at 100 or 200 or 500, but would buy it at 50. It's totally irrational, but people would rather buy 20 shares at 50 than 2 shares at 500, even though they've got the exact same amount of money tied up in the investment. So we've got more people buying and selling those shares, which means the market for our shares is more liquid. If our shares are more actively traded, that decreases the risk that I might get stuck holding them when I'm looking to sell. Decreased risk will push up stock price. So there's one possibility. Another possibility is that the wider ownership associated with lower stock price creates positive vibes among consumers. The first investment I ever owned was Coca-Cola. I was 5, and my dad said to me, "Son, it's time you started to invest." And my brother, who was 5 years older than me, and I said, "We want to invest in Coca-Cola." And my dad said, "I don't think that's a wise investment, boys." And we basically said, "Screw you, we want Coke," though in a much more age-appropriate manner. And he shook his head and said, "Okay, if that's what you really want," expecting this would become a teaching moment for us. As it happens, its price doubled, and then doubled, and then doubled, and then doubled, and turned out to be quite a coup for the Barrett boys. But I digress. After we bought the stock, whenever we'd go to the grocery store, we'd pester my mom to buy Coke. "Well, why do you want me to buy more soda?" "Not just soda, Mom, Coke. We buy more Coke, stock price goes up." And my father says, "Well, son, it doesn't really quite work that way." And I said, "What do you mean? We buy more Coke, they make more money, their stock price goes up." He looked at me blankly for a few seconds before muttering, "Okay, so maybe it does work like that, but we're not buying any more soda anyways." And for years afterward, I would have nothing to do with Pepsi products. Being a shareholder in Coke made me feel like I owed them my business, made me feel dishonest by buying from a competitor. And that's something a company would like to promote. And here's a little evidence from Coca-Cola. On May 10th, 1996, Coke had a closing price of $83.87. They then had a 2-for-1 stock split. And the opening price on the next day of trading was $43 even. $43 on Monday would suggest $86 on Friday, but Friday's price was only $83.87. There seemed to be some value created simply by the act of splitting the shares in two. Okay, just for the record, not all of my investments have been good. I actually had a company that did a reverse stock split. They took 3 of my shares and gave me back 1. Why did they do that? Because the minimum price for their exchange was $3 a share, and they had fallen below 2. So they either scrambled and did the reverse split, or they got delisted. Oops. The next page of your notes has a worksheet that illustrates the difference between a stock split and a 100% stock dividend. So before anything happens, we've got 20,000 authorized shares, 5,000 outstanding shares, 1,000 shares in treasury. The value in the common stock would be shares issued times par, or $60,000, and we're told that retained earnings is $300,000. So what happens if we have a 100% stock dividend? We're issuing more of the same shares that already exist, and simply issuing shares doesn't change the number authorized, so that's going to stay the same. All those shares that were outstanding, however, have now doubled from 5,000 to 10,000. Treasury shares don't get to receive dividends, so we continue to have 1,000 shares in treasury. Common stock will go up by shares times par, or $50,000, so the value in the common stock account will become $110,000. And where did that 50 come from? Well, it got transferred from retained earnings, so that drops to $250,000. If, on the other hand, we have a 2-for-1 stock split, we are pretending to go back in time and fundamentally change the nature of every share of stock. This means we no longer have 20,000 $10 par shares authorized. Instead, we've got 40,000 $5 par. Shares outstanding double to 10, not because we issued shares like above, but because we told all of our shareholders to figuratively tear their shares in two, doubling what's out there. The treasury shares are also split. When we reissue those shares, they'll need to conform to the new $5 par, so we're tearing up all of our treasury shares in half as well. What happens on the balance sheet? Nothing. Common stock is unchanged. We've doubled the shares, but we've halved the par value, so that stays at 60. And retained earnings, of course, stays the same. So here we have two different ways of doubling the shares held by shareholders, and while both result in 10,000 shares outstanding, the side effects of that doubling is different from one method to another. Okay, a couple parting thoughts. Dividends are an important part of the return investors receive on many stocks. One measure that people often use in this regard is dividend yield, which is the annual dividends per share divided by the price per share. The yield calculation is comparable to a yield on a bond, but should not be compared directly with that same company's bond yield. Why? Well, because they're not comparable. We should expect them to be different, and always different in the same direction. Would we expect the dividend yield to be higher or lower than the bond yield? It would seem to me that the dividend yield should be quite a bit lower, even though the stockholder is taking extra risk. Why? Well, let's take a look at Coke's 2009 data. Coke's average yield on its long-term debt was about 5 3/8 or so during 2009. Its dividend yield was only 3.4%. So yes, it appears that dividend yield is less than the yield you'd get by loaning them money. Let's look at the other part of the formula. Their stock price at the beginning of the year was $45.90, and their stock price at the end of the year was $68 even. Not too shabby. And when we add in the dividends, the total return you would have gotten by holding Coke during 2009 was about 52%. Now this is clearly out of the ordinary, but that's what you get when you buy shares of stock. The sky is the limit with equity investments, whereas our return on a debt investment has very little upside potential. Return on equity is another measure that we can use to assess firm performance. It's calculated by subtracting preferred dividends from net income and then dividing that result by total equity. Managers have been entrusted with the money by shareholders. That's equity. How well are they using that money to generate a return for the common shareholders? Note, however, that this is not the actual return an investor will earn if they buy shares of stock today. ROE is calculated based on historical cost balance sheet data, not market value of equity. Lastly, remember that comprehensive income stuff. I have reproduced the comprehensive income portion of Coke's statement of stockholders' equity for you at the back of your notes packet. Keeping in mind that these numbers are all in millions, we are looking at significant swings in shareholders' equity due to foreign currency fluctuations, pension liabilities, and other items. These are true changes in shareholder wealth, but are not reported on the income statement. Make sure you're keeping up with these things. That's a lot of money. So that's the end of the balance sheet. This would be a good time to take a look at Assignment 2 and get plugging away at it. It's relatively time intensive, but it's an excellent review of all the stuff we've done so far. Chapter 9 will turn to the income statement, and then we will wrap up our section on financial reporting with cash flows in Chapter 10.